Have you ever looked at your savings account and felt proud because the number kept growing? Most people believe that saving money is the key to becoming financially secure. While saving is one of the smartest financial habits you can build, it is only the first step. What many people don't realize is that every year, inflation quietly makes your money worth a little less. The cash that buys 10 groceries today may only buy 8 or 9 in the future. Even though your bank balance stays the same, your purchasing power slowly shrinks. Imagine putting money inside a drawer and leaving it there for 10 years. Your cash stays exactly the same, but the cost of food, housing, fuel, and everyday essentials keeps rising. Now imagine putting that same money to work by investing wisely. Instead of sitting still, it has the opportunity to grow alongside the economy. In this video, you'll discover a simple, beginner-friendly roadmap to turn your savings into investments safely and confidently. My name is Max, and I'll be your guide every step of the way. So don't forget to hit the subscribe button and give this video a thumbs up. Let's get started. Saving money is more than simply putting cash into a bank account. It is the habit of setting aside part of your income today so you can handle tomorrow's needs with confidence. Whether your goal is buying a car, taking a vacation, paying for education, or preparing for unexpected emergencies, saving gives you financial stability and peace of mind. Think of savings as your personal safety net. If your car suddenly breaks down, you lose your job, or a medical bill appears unexpectedly, your savings can help you manage these challenges without relying on expensive loans or credit cards. A good financial rule is to build an emergency fund that can cover 3 to 6 months of essential living expenses. This money should stay in a safe and easily accessible account because its purpose is protection, not growth. Saving creates the strong financial foundation that every successful investor needs. Without a solid savings plan, investing can become stressful because you may need to withdraw your money at the wrong time. Before learning how to grow your wealth through investing, always make sure your savings are working as your financial safety net.
Have you ever wondered why the same amount of money seems to buy less every year? The answer is inflation.
Inflation is the gradual increase in the prices of goods and services over time.
As prices rise, each dollar you own loses a little of its purchasing power.
Imagine you have $100 today. It might be enough to fill your grocery cart or fuel your car.
But several years from now, that same $100 may only cover part of those same expenses because prices have increased. Inflation often happens so slowly that most people barely notice it. A cup of coffee, a loaf of bread, movie tickets, and even monthly rent all become more expensive over the years. If your money stays in a place where it earns very little, it may not keep up with rising costs. That is why simply saving cash is not always enough for long-term financial success. To protect your future purchasing power, your money needs the opportunity to grow faster than inflation.
Understanding this simple idea is one of the first steps toward becoming a smarter investor. Have you ever wondered why people invest instead of simply keeping all their money in a savings account?
The answer is simple. Investing gives your money the opportunity to grow. When you invest, you're putting your money into assets such as businesses, stocks, bonds, real estate, or funds that have the potential to increase in value over time. Instead of your money sitting still, it begins working for you. Think of investing like planting a small seed. At first, it may not look impressive, but with patience, regular care, and enough time, that seed can grow into a strong tree. In the same way, even small investments made consistently can grow into significant wealth over many years. Of course, investing isn't a way to get rich overnight. Markets rise and fall, and prices can change from day to day. But history has shown that patient, long-term investors have often been rewarded for staying invested. The goal isn't to chase quick profits. It's to steadily build wealth, stay ahead of inflation, and create a stronger financial future for yourself and your family.
Many people think saving and investing are the same, but they serve very different purposes.
Saving is about protecting your money and keeping it available for short-term needs. Investing is about growing your money over the long term, even though its value may go up and down along the way. Think of saving as parking your car in a safe garage. Your car stays protected and is ready whenever you need it.
Investing is more like sending that car on a journey to earn rewards. The trip may include bumps in the road, but it also offers the opportunity to reach a much bigger destination. Savings accounts are ideal for emergency funds, vacations, or purchases you plan to make within the next few years.
Investments, on the other hand, are better suited for long-term goals like retirement, buying a home, or building lasting wealth. The smartest financial plan doesn't force you to choose one or the other. Instead, it uses both together. Save enough to handle life's unexpected expenses, then invest the money you won't need right away so it has the chance to grow and outpace inflation over time.
Many people ask, when is the right time to start investing?
The answer isn't based on your age or how much money you have. It's about building a strong financial foundation first.
Before you invest, make sure you have an emergency fund that can cover at least 3 to 6 months of essential living expenses.
This safety net helps you avoid selling investments during unexpected situations. Next, take a close look at your debt. If you have high interest debt, such as credit card balances, paying it off should usually come before investing. The interest you save is often greater than what you might earn from investments.
You should also have a steady source of income. Regular income allows you to invest consistently, even if it's only a small amount each month. Finally, set clear financial goals. Are you investing for retirement, a home, your children's education, or financial freedom? Knowing your purpose will help you stay focused when markets fluctuate.
You don't need thousands of dollars to begin. Once your financial foundation is in place, starting with small, consistent investments is often the smartest way to build long-term wealth.
Many beginners think investing is too risky, but the truth is that every investment carries some level of risk. The important thing is not to avoid risk completely, but to understand it and manage it wisely.
Market prices naturally move up and down every day. Some days your investments may gain value, while other days they may lose value. This is a normal part of investing. One of the best ways to reduce risk is through diversification. Instead of putting all your money into a single investment, spread it across different assets, such as stocks, bonds, ETFs, or index funds. If one investment performs poorly, others may help balance your portfolio. Another key to managing risk is having a long-term mindset. Short-term market declines can feel uncomfortable, but history has shown that markets have generally grown over long periods. Successful investors stay focused on their goals instead of reacting to every market movement. Remember, risk cannot be eliminated, but with patience, diversification, and smart decisions, you can build wealth while keeping your investment journey on a steady path. One of the most powerful tools in investing is compound growth.
It simply means that your investment earns returns, and then those returns begin earning returns too.
Over time, this creates a snowball effect, allowing your money to grow faster without you having to work harder.
Imagine investing $100 every month. In the beginning, the growth may seem small, but as the years pass, your investments continue to earn returns, and those returns are reinvested to generate even more growth.
The longer you stay invested, the more powerful compound growth becomes.
This is why starting early is so important. Even small amounts invested consistently can grow into a significant amount over time. Waiting just a few years to begin could mean missing out on years of compound growth.
The secret isn't finding the perfect investment or becoming rich overnight. it's giving your money enough time to grow. By investing regularly, staying patient, and letting compound growth work in your favor, you can build wealth steadily and move closer to your long-term financial goals. Now that you understand the basics of investing, the next question is, where should you invest first?
The good news is that you don't have to pick the next big company to become a successful investor. For most beginners, simple and diversified investments are often the best place to start. One popular choice is an index fund or an ETF, which allows you to invest in hundreds or even thousands of companies through a single investment. Instead of depending on one business to succeed, your money is spread across many companies, helping reduce risk.
You may also hear about individual stocks, where you buy shares in a single company. While they offer the potential for higher returns, they also come with higher risk because your investment depends on that company's performance.
The key is to choose investments that match your goals, your time horizon, and your comfort with risk.
You don't need a perfect portfolio on day one. Start with simple, diversified investments. Continue learning and build your portfolio gradually as your knowledge and confidence grow.
One of the easiest and smartest investing strategies is called dollar cost averaging, or DCA. Instead of trying to guess the perfect time to invest, you simply invest the same amount of money at regular intervals, such as every month. For example, imagine investing $100 on the first day of every month. When prices are high, your money buys fewer shares. When prices are low, the same $100 buys more shares. Over time, this helps average out the cost of your investments and removes the pressure of trying to predict the market. Dollar cost averaging also helps control emotions. Many beginners become excited when prices rise and afraid when prices fall. DCA encourages you to stay consistent, regardless of what the market is doing. Instead of reacting to headlines or short-term price movements, you continue following your investment plan. No one can consistently predict the market, but by investing regularly, staying disciplined, and thinking long-term, you give yourself a better chance of building wealth steadily while avoiding many of the mistakes caused by emotional decision-making.
Every investor makes mistakes, especially in the beginning. The good news is that many of the biggest mistakes can be avoided. One common mistake is trying to time the market. Many beginners wait for the perfect moment to invest, but no one can consistently predict when prices will rise or fall. Another mistake is panic selling during market declines. When prices drop, some investors sell out of fear and lock in their losses. Experienced investors understand that market ups and downs are a normal part of long-term investing. Some beginners also chase popular stocks simply because everyone else is buying them. Investing based on hype instead of research can lead to disappointing results. Finally, many people forget the importance of diversification and put too much money into a single company or investment. Successful investing isn't about being perfect. It's about avoiding costly mistakes, staying disciplined, and following a long-term plan. If you remain patient, keep learning, and invest consistently, you'll be in a much stronger position to build lasting wealth over time.
Now it's time to put everything you've learned into action by creating your monthly income and subtracting your essential expenses, such as housing, food, transportation, and utilities. The money that's left can be divided between your emergency fund and your investments. Once your emergency fund is fully built, make investing a monthly habit. Set aside an amount that fits your budget, even if it's only $50 or $100 each month. The most important thing is to stay consistent. To make investing even easier, consider setting up automatic monthly contributions. This allows your investments to grow without having to remember each month. As your income increases over time, gradually increase the amount you invest. Your investing plan doesn't need to be perfect. It simply needs to be realistic, affordable, and easy to follow. Small, consistent actions repeated month after month can lead to meaningful financial growth. Remember, building wealth is not about making one big decision. It's about making many smart decisions consistently over time. Congratulations! You've taken an important step toward understanding how to turn saving into investing. By now, you've learned why saving alone isn't enough, how inflation affects your money, how investing helps your wealth grow, and why patience and consistency are the keys to long-term success. Remember, you don't need a large amount of money or years of experience to begin investing. What matters most is getting started. Even small monthly investments can grow into something meaningful when you stay committed and give your money time to work for you. Don't worry about being perfect or finding the perfect investment. Every successful investor started as a beginner. Keep learning, stay disciplined, and trust your long-term plan. Thank you for watching this video. I hope it has given you the confidence to take your first step toward building a stronger financial future. If you found this guide helpful, please give this video a thumbs up, subscribe to the channel, and turn on the notification bell so you won't miss future finance lessons. Until next time, I'm Max, wishing you success on your investing journey.